And the markets bottomed a few sessions after so-called Liberation Day, April 2nd, when US President Donald Trump unveiled his sweeping tariffs. The market has bounced back since then. Our guest says this is a tricky spot and there is a real risk that stocks go down again and actually drop below their previous lows of April. We're joined by David Burrows, President and Chief Investment Strategist at Barometer Capital Management. David, great to see you.
Good to see you, Andy.
So let's put up, say, a 1 year for the S&P 500.
Yeah.
We've seen this very sharp rally, but
Yeah.
you say we ain't out of the woods yet.
Look, I don't. You made me sound a little bit like a super bear, and I'm not.
Okay.
But what I would say to you is, there's a big range of possibilities, right? And since the market made lows in April, we've had a great bounce. You can see on the chart, it has not made a higher high. It continues to be market S&P below the 200-day. NASDAQ is below the 200-day moving average. Russell 2000 is below the declining 200-day and 50-day moving average. You know, there's nothing technically that you can say we have reversed this downtrend. And it may well be that as news gets a little better, we work our way higher. It's about picking your spots, right? But I think it's interesting that in the last 4 weeks, you know, private investors have been massive buyers of shares. Hedge funds and institutions have been sellers. So, you know, keep in mind, there are some big tailwinds in certain parts of the market, like global stocks. Global stocks went down less and bounced right back to new highs. And they've been outperforming for months. Global stocks look great. Certain sectors look good, like financials. But there's some big economically sensitive sectors like industrials, in particular manufacturing, machinery, transports, chemicals, economically sensitive stuff that really has had almost no bounce off the lows. So the market points towards some sort of economic weakness. We're having earnings that are coming in that are backward looking. The near-term data, the soft data, poses a little bit more cautionary tale. So I think that it's prudent to be balanced. There's some great stuff, but it's okay to have a little cash and be a little flexible as the news unfolds.
I'm showing the MSCI World Index as down from its highs, but certainly it has outperformed US stocks this year.
Well, so now the MSCI All World Index has a giant US weight.
Oh, of course, yeah.
So the MSCI All World ex-US is up about 8%, where the S&P's down. So since November, there's like a 15% delta between the two.
Yeah.
Frankly, Canada's acting more like the All World Index because both Canada and the All World ex-US Index have over 30% financials, and financials look just great.
As you say, I should remember the MSCI World was stuffed with US stocks. As you say, it's up 8% this year.
Yeah, it's performing really well. Europe is making new highs. Asian markets are performing well. Latin American markets like Argentina and Chile are performing well. So it's interesting because everyone's so focused on the tariffs. So you would think that global stocks would be having a tough time, but frankly, you know, it's a very mixed market.
You're cautious. Your portfolio's a big cash and short-term bond weight of up to 30%.
Yeah, we have 20 to 30% would be cash and short-term bonds. We have about a 15% global ex-US weight, which we built over the last year, and we have almost no technology or big cap growth stocks. We think that is the risk. They're owned by everyone, especially international investors. International investors now have currencies going up and their markets are going up. After 10 years of their currencies weakening and needing to go to the US to get growth. So it doesn't take much for them to say, and they may not be super happy with what's going on in the US right now, to say, we're going to take a little bit home, right? We're going to buy our currency back because it's appreciating. We're going to buy our market because the market's appreciating. And those flows and that shift in flows, I think, has only just begun.
You're not that keen on precious metals right now, David.
No, we've been, yeah, that's something else. We're long precious metals and have been for 18 months.
Okay.
But about 2 weeks ago, the GDX and the gold index got very extended away from the 200-week moving average, which historically, when you got 70 to 75% above the 200-week moving average. It was stretched and would tend to correct. So in 2006, after the first big rally, you had a correction once we got to 70% above. It was stretched. The one thing that could be different here is that really the Chinese are the big buyers, and it's actually the Chinese central bank putting their currency reserves into gold instead of treasury bonds. So they're a big support, but Chinese retail are big buyers of gold as well.
So you still have a decent gold, a big gold weighting, but you have cut back slightly.
Yeah, I mean, it's been a tremendous asset for the last 18 months. We own Agnico, we own Kinross, we own Wheaton Precious Metals. We sold about a third of our position.
Right. Just on financials, Fairfax attracts you these days.
Yeah, Fairfax has been the largest position at the firm for the last 18 months. If you look in financials, property and casualty insurance have been about the best performing sector. Whether you're looking at Intact or whether you're looking at Fairfax, which we own both of, or whether you're looking at Berkshire, or whether you're looking at Progressive, which we also own in the US. All of them have had hard pricing, so their margins have been strong, and they've all been performing well. We're basically at highs in all of them.
Okay, David, thank you very much. Yeah, there's Intact Financial, the giant insurer. Yep, okay. Canadians love their insurance, apparently.
Well, globally. No,
Yeah.
it's happening globally.
David, thank you very much.